announcements possible post-December as well. So watch out for that. Watch out for L&T Finance. And let's get in Mr. N. Sivaraman, who is the President and Wholetime Director at L&T Finance Holdings. He joins us on the show to talk about the numbers. Good having you, Mr. Sivaraman. Thanks for joining in. What's led to this healthy NII growth and what kind of margin expansion has come about in Q2?
The second quarter margins have improved by about 34% year on year. Okay, that's largely driven by two factors. One is the asset growth itself, which is about 21%. Then the other reason has been the margin expansion as well. The margins have expanded by about 50 basis points quarter on quarter, largely contributed by the retail asset segment. The retail asset segment margin has improved during the quarter by about 1.25%. Of this 1.25%, maybe about 40 basis points are not maybe one-off, but otherwise about 75 to 80 basis points is actually a sustainable increase in margin that have come through. This increase has come on the back of our expanding the B2C segment of the business, and cost of reduction in the cost of borrowing by about 20 odd basis points. So all of this have really contributed to a very strong NIM growth during the quarter.
Right, Mr. Sivaraman, so is the margin performance sustainable? Where do you see margins over the next few quarters?
Well, nobody is reducing the borrowing cost on the ground as of now. So consequently, I think the margin might, as I mentioned, about 30-40 basis points of the retail book, which is about 20 basis points on the consolidated book, is a one-time effect. Other than that, I think our margins will be in the region of about 5.85 to 5.9%, which is about 15-20 bips drop from the third quarter, which is explainable. But the general trending will be for margins to remain stable to improving as we are able to substitute more expensive borrowing with lower cost borrowings. Because as you know that on the back of government security prices or the yields coming down, we have seen even the corporate borrowing costs have been coming down over the last 2 quarters. That's helping us improve the margins as well.
Mr. Sivaraman, the asset quality has improved. What's led to the reduction in NPAs, and what is the asset sale to ARCs that has been done in this quarter, quarter 2?
Yeah, 2 things we have done. One is that we have improved the provision coverage from 26% to 33% between the 2 quarters. So at the net NPA level, the improvement is a contribution coming from both the reduction in the NPAs as well as the provision coverage increase. This is more as a policy that we are trying to work towards increasing the provision coverage without any regulatory requirement of providing additional provisions. The sale to ARC is about 190 odd crores of rupees. We sold it about 100 crores. 90 odd crores have been the discount or the loss on the sale of these assets. This being absorbed in line with the regulatory provision, which say that this can be absorbed in 8 quarters, which is what we will do. 1 quarter as absorption has already been done. The balance will be absorbed in the next few quarters.
Right. So what's the kind of provision cover ratio that you're going to see over the next few quarters?
Yeah, I think this will go by about another 5 to 7%, which should be sufficient comfort for the health of the balance sheet on a long-term basis. The reduction in the NPA on the retail segment, yes, by 31st March we would see a reduction, while in December there may be a blip because of seasonal reasons. The wholesale NPAs will take time to come down because the resolution periods are longer, multiple lenders are involved. It also depends on the way the overall company starts seeing better cash flows from where they are today. While there may not be an increase in NPAs, but we will end up see the reduction coming through in about 2 to 3 quarters. That will be good. If 2 to 3 quarters we are able to reduce the NPAs, I would say it will be a very, very helpful situation.
Disbursement growth has been healthy at 24%. Have you started lending again to CE segment, and what's the status on infra lending?
We have been very cautious in lending to the CV and CE segment. While there are some disbursements do happen on selective cases, but we have been reducing the our exposure to the CVC segment over the last 3 years. If you take the current quarter, we have reduced the disbursement by about 60 to 70% to this segment. This on the back of very weak fundamentals, both at the operating cost levels as well as the freight realization levels as well. I think it will take about 2 quarters. There is a belief that at the moment it has bottomed out, and we could perhaps see some pickup. Yes, the diesel prices have got reduced. The freight volumes just showing some improvement tendencies, but I would say it is a little too early to coming to any assessment that the sector has changed dramatically. As far as the construction equipment is concerned, yes, the operating cost ratios could improve, but still the new orders or the new opportunities for them to hire out the assets are still some distance away because the projects are really not taken off any significantly. We'll continue to remain cautious in this segment. The growth has been primarily based on our own strategy of focusing on B2C segment as far as the retail asset book is concerned, and focusing on operational assets in the infrastructure segment. This is where our opportunities for disbursement have come through, and we do see that this will continue to provide us with opportunity for the next half year as well.
So what's the kind of loan book growth target that you have in mind, say over the next 1 to 2 years, and how will the mix between retail, wholesale and lending to housing segment pan out?
Well, this year our outlook will be that we could see a 20% growth in the loan book. That's what our outlook is. We will not be disappointed if it is marginally short of 20% because we have been very focused on quality that we pick up. If all the government initiatives do flow through and then we start seeing some projects coming up in the next say 2 quarters, I think next 2 years we can see very, very healthy growth. I won't be surprised if we do a 30% kind of growth for the next 2 years. All this is subject to the government action really coming through onto the ground.
The government has denationalized coal. How do you see it impacting coal and the related sectors, and also your expectations from the government on resolving the infra bottlenecks that exist?
Well, the first is that on the coal block issue, it's going to resolve issues for plants which are operational and under construction to whom coal blocks have been allocated. So that's not going to create any new project. At least the uncertainty around availability of coal for these projects will disappear. And the next maybe 3 to 4 quarters we'll see a very steady performance by this sector. As far as the new projects are concerned, we'll have to see the basis how the real auctions work out. Does it create any competitive disadvantage for the private sector players as compared to the public sector players to whom coal will be on an allocated basis? So we will have to wait and see how this will pan out in the next 2 years or so. Infrastructure sector, I think the government is trying to work on land purchase processes, and also the maybe an accelerated implementation program by NHAI could also help in reviving this sector. We are hopeful. We'll have to see action on the ground as of now.
Right. So how sufficient are you on the capital front, and any capital raising plans that you may have over the next 1 year?
We have, in the current year, I don't see ourselves really hitting the market for any capital raise unless the growth really overtakes our assessment. We have used the holding company balance sheet to leverage, raise some preference capital and provide capital to our operating subsidiaries. So consequently, I don't see ourselves needing a capital before the end of this fiscal. Next year, as we start the planning for the next year by the 4th quarter of this fiscal, we will evaluate and then take a call on whether we need to raise equity or not.
Okay, Mr. Sivaraman, thanks so much for joining in today, and all the best for the quarters ahead. Hope you repeat what you've done this quarter or maybe better it. That's L&T Finance, fairly decent quarter that they've come out with for this time around. What we'll do is take a very quick break. Come back, get you more ideas from our